When you reach retirement, one of the biggest decisions you'll face is whether to take your 25% tax-free lump sum, also known as the Pension Commencement Lump Sum or PCLS. It sounds simple. Why wouldn't you take tax-free money, but get this wrong and you could end up paying tens of thousands more in tax over your lifetime? In this video, I'll explain how the lump sum works, why the default strategy is usually to spread it out, the main reasons people get it wrong, and some valid cases where taking it early can be a smart move. And a quick disclaimer, this isn't personal financial advice. Everyone's situation is different, so make sure you do your own research or seek guidance before acting. And remember, if you do enjoy our content, don't forget to subscribe and to like this video. So what is the tax-free lump sum? Well, the idea behind the PCLS is that you can take it after retirement age, so that's age 55 currently, and it's going to increase to 57 from 2028 onwards. So you can take a quarter of your investment pot in your pension tax-free. However, there is a lifetime limit of £268,275, and that's spaced across your entire life. Now, once it's taken, it's irreversible. That means that it's gone permanently. And after it's taken, all further withdrawals are fully taxable as income. Now, you don't have to take all of your tax-free cash in one go. You can spread it out over time. So let's look at a real-world example. So here's Sarah. She's 62. She's got a £300,000 pension and she wants a £30,000 a year gross income in retirement. Now, if Sarah drains her entire tax-free cash up front, she has nothing left but the taxable part. She can use up her tax-free allowance of £12,570 a year, and the remainder, in yellow, is taxed at 20%. But when her state pension kicks in later, it'll probably use up her personal allowance, meaning every extra pound she takes from her pension is taxed at 20%. But here's another approach. Again, Sarah withdraws £30,000 per year from her pension, of which £12,570 is within her personal allowance, so it's tax-free. She also unlocks 25% of the 30k as phased UF+, or uncrystallised funds pension lump sum. Well, now she's saving £1,500 in tax every year. Now that's a huge difference, and by being tactical, Sarah saved thousands in tax and also preserved her tax-free pot to keep growing. Altogether, she could pay no tax at all on an income of up to £16,760 every year, and a couple, of course, could withdraw over £33,000 per year tax-free using this phased UF+ withdrawal approach, assuming they have roughly equal size withdrawal amounts. So as you can see, there are good reasons why you might want to hold back. So in the example with Sarah, we could call that tax drag. If you use all your pension commencement lump sum early, you'll likely pay more income tax later. Withdrawing a lump sum for consumption early on in retirement means you end up with a smaller pension pot, and that usually means less retirement income overall. Secondly, you lose the huge tax-free compounding inside a tax-sheltered account over what could be decades of retirement. Money outside a pension may face income or capital gains tax unless it's inside an ISA, and it could take many years to be able to put your lump sum into an ISA due to the relatively small size of the annual ISA allowance. There are also recycling restrictions. You can't just put the lump sum straight back into a pension because this is cash that has already benefited from tax relief. HMRC ensures you don't do this so-called double dipping. And remember, most of us live on into our 80s and 90s, and running out of money is a real risk. Now, if this seems complex, well, it is, and that's why you might want to do cash flow modelling. And the primary challenge here is that these principles we've discussed play out differently for everyone. And that's why cash flow modelling is so powerful. It shows how decisions that you make today ripple through your tax bill and retirement income over many decades. So let's take this example using My Finance Future, a very powerful cash flow planning app. Now you get a 40% discount on My Finance Future via your PensionCraft premium website membership. So here we've got a couple, an AI couple it has to be said, both are 55. The main earner has an 80k salary and a 600k pension. The partner has a 40k salary and a 200k pension, so a difference in the size of the pots. They have a £200,000 mortgage, they're paying 4% on it. They have a £25,000 car loan where they have to pay 7% per year. They don't have any ISAs and they have 15k in cash savings. Their current annual spending is £72,000 a year and they're aiming for £65,000 a year in retirement. Now you can see that they've got two AI kids, and those two AI kids don't come cheap. It's going to cost £90,000 to send them to university. So with My Finance Future, you can create these cash flow projections. So what we've done here is to create a base case in which you fund everything with UF+. Now that actually triggers the money purchase annual allowance, which limits how much money you can put into your pension every year. This also results in draining the partner's pot early on, and it also breaches a lump sum allowance. So this plan actually comes up with a big tax bill and also a very large shortfall, which is the pink regions you can see on this graph. So with these cash flow planning tools like My Finance Future, you can try various things out. So in this scenario, for example, you can take the tax-free cash up front as a PCLS. That doesn't trigger the money purchase annual allowance. Then with the tax-free cash, the couple builds their ISAs and they also cover university costs. They also balance up their pension pots and overall reduce tax drag. Their shortfall is reduced to £57,000. So I think the big takeaway here is that cash flow modelling shows you the quite subtle trade-offs. What looks obvious in the first instance, like paying off a mortgage, may not always be the best strategy once you take tax and allowances into consideration. Now, there are other questions you may want to ask about your investments in retirement, such as whether you're going to run out of money. And here, some of the PensionCraft premium membership tools are incredibly useful. Here you can see that suite of tools. And for example, if you want to know whether you'll run out of money, you can do it using Monte Carlo simulation. So here's your drawdown forecast, where you can enter various details about your investments, your expected return and volatility, and then you can work out the probability of running out of money over the course of your lifetime. You also get lots of other goodies with your membership, such as the ability to chat to other members and ask me and those members a question anytime you like using our chat application. If you want to learn more about joining our community, it's really easy. Just go to our website, pensioncraft.com/membership, or use the link in the description below. Now, sometimes taking your lump sum early really does make sense. So here are some examples. With speculation around the November 2025 budget, some people are worried that the rules could change. And while drastic overnight cuts are unlikely, a partial lump sum now could be a hedge against cutting the allowance in future. For example, you could put this partial lump sum into your stocks and shares ISA, and diversifying across pensions and ISAs may reduce your exposure to future policy shifts. If you have high interest loans, then it may make sense to pay these off. Paying off a 4 to 7% mortgage or loan is equivalent to giving you a guaranteed return, and this may be attractive since mortgage rates have now risen. However, it might be a good idea to compare with the UF+ tax saving to see which benefits you the most. If you have a life-shortening medical condition, then this probably means you have a shorter investment horizon. Taking some of your tax-free cash earlier and enjoying it could be a good use of your money. If you're in a relationship, this is definitely an option worth considering. I mentioned earlier that a couple could withdraw up to £33,000 tax-free if they both have roughly the same sized investment pots. However, this is often not the case. Sometimes I speak to people whose spouses have very little pension saving. If you withdraw tax-free cash and contribute to your spouse's pension in these situations, you could gain more tax relief by using both of your tax-free allowances. And don't forget that you can carry forward up to 3 years unused allowances. When you take PCLS, the 25% tax-free cash, the money leaves the pension and becomes part of your personal assets. If you gift that cash, HMRC views it as a potentially exempt transfer, or PET. That means that if you survive 7 years after making the gift, it falls outside your estate, which means no inheritance tax is due. If you die within 7 years, it may be counted for inheritance tax, subject to the nil rate band, which is £325,000, and also taper relief if you survive for more than 3 years. And you also get annual gift exemptions. You can give away up to £3,000 per year for small gifts of under £250 per person and normal gifts out of income. And these are immediately outside inheritance tax without needing the 7-year rule. So as you can see, it's not a trivial decision about whether to take your tax-free cash up front. It really does require some kind of cash flow modelling to understand it properly. So with a PensionCraft membership, don't forget you do get access to that My Finance Future discount of 40%, and you get access to all the goodies of membership of PensionCraft. Now, if you did want to join our membership, it's really easy. Just look at the link in the description below or go to pensioncraft.com/membership. And as always, thank you for listening.